very good evening to ladies and gentlemen. I'm excited and I warmly welcome you all to the sixth webinar of the webinar series organized by the Seminar Committee of the Bar Association of Sri Lanka. And today's topic will be on the changes proposed by the Indian Revenue Amendment Bill 2022. This webinar series is conducted on the platform. And for those who are being unable to register us on the Zoom, could join by watching the live stream on the BASL YouTube channel. And also would like to thank especially the Seminar Committee of the Bar Association of Sri Lanka, headed by the Surupala Patabandi, Attorney at Law, Secretary to the Bar Association, for taking this inception to start this webinar series in 2022. Again, I would like to thank the President of the Bar Association of Sri Lanka, Mr. Salia Peri, all the support and guidance given to us in organizing this webinar series. So today's topic will be on the proposed amendment and changes introduced by the Inland Revenue Amendment Bill 2022. And joining us today, we have a distinguished panel of experts here with us today to enlighten us and share their knowledge on this vast topic. And we have 3 panelists and 1 moderator for today. And so each panelist will have more time to share their knowledge and experience with us on this topic. And I now take this opportunity to introduce the esteemed panel and the moderator for today. I would like to introduce Mr. Suresh R.I. Pereira. Mr. Suresh R.I. Pereira, Attorney at Law, is the Principal Tax and Regulatory at KPMG Sri Lanka, and he's also a multidisciplinary professional with over 25 years experience in taxation, accounting, and legal aspects, and he is a member of KPMG Middle East and South Asia Tax Steering Committee. Mr. Pereira is the chairman of Tax Committee of the Bar Association of Sri Lanka, and he's also a member of the CA Board of Management of the Integrated Reporting Council of Sri Lanka. He's also a member of CIMA Global Council Membership Committee and AICPA Examination Board. I warmly welcome you, sir. Next, we have Mrs. Tanuja Pereira, Attorney at Law. Mrs. Pereira is a policy advisor to the Ministry of Finance, and she possesses a degree of Master of Business and Business Administration in Taxation, and also a postgraduate Institute of Institute of Management, University of Sri Jawaharlal. And she also has a Master of Laws degree from University of Colombo, and has majored in the areas of banking law, company law, and international trade law. Next, we have here with us today Mrs. Shamin Tilakaratna, and she is a partner and a tax leader of PricewaterhouseCoopers. She has a very vast experience both in professional service firms and the mercantile sector. And she is a multidisciplinary professional qualified in both law and accountancy. She is associate member of the Chartered Institute of Management Accountants, UK, and is a chartered global management accountant, associate member of the Institute of Chartered Accountants, and also attorney at law of the Supreme Court of Sri Lanka, and also a member of the Tax Committee of the Bar Association of Sri Lanka previous year. Ms. Shamin Tilakaratna has vast experience in the field of tax, and it includes advising clients on international cross-border tax planning in the context of treaties for relief from double taxation, corporate and individual income tax, and so forth. She also possesses experience in carrying out tax due diligence based on electronic data rooms and physical data rooms. Mrs. Shamin has also been involved in lodging appeals on behalf of clients to the Commissioner General of Inland Revenue Tax Appeal Commission and assisting legal counsel in tax litigation. I warmly welcome you to both for the webinar as well. At last, and but not least, we have our moderator for today's session, Mr. Rakita Mr. Rakita. He holds an MBA with a merit pass from University of West London, and he also possesses a Bachelor of Law degree from the University of Colombo and a BSSC from in Applied Accounting from Oxford Brookes University. He's a member of Association of Chartered Certified Accountants in the UK, and he's also a secured. He has also secured a first class honor at the Sri Lanka Law College. Mr. Rakita was called to the bar as an attorney at law in 2008. And he also has a diverse background in academic and also in professional qualification, and is aptly reflected in his dynamic and multidisciplinary career profile. He, as I said, he's also an attorney at law of the Supreme Court of Sri Lanka, and he specialized in the areas of tax law, company law, contract law, and also in intellectual property and commercial law, and has more than 14 years of experience in the field. He also worked as a legal consultant at the Chambers Colombo law firm, Colombo 7. And also he's a former council member of the members network panel of the ACCA Sri Lanka and a member of the tax committee of the Bar Association of Sri Lanka. Further, he was a member of the advisory committee to the review of the reciprocal enforcement of foreign judgments ordinance appointed by the Minister of Justice. So with that, I conclude the introduction of the panelists and the moderator for today. And now I take this opportunity to welcome our distinguished panelists and the moderator for today's webinar. And now I hand over today's proceeding to Mr. Jayatunga to carry on today's proceeding with here on. Over to you, sir.
Thanks, Nikki. Thanks, Nikini, for the lovely introduction. Good evening to all of you. Once again, welcome to this special webinar organized by the Bar Association of Sri Lanka on changes proposed by the Inland Revenue Amendment Bill. We all are aware that these changes are going to have a serious adverse impact on all types of taxpayers across the country, as the government has decided to increase their revenue by increasing the tax rates while abolishing the tax exemptions and the concessions currently available. In doing that, they have not made much effort to reduce on their government expenditure. So this webinar focuses on three main areas. One will be on personal income tax, then corporation tax, then also the proposed provisions pertaining to tax administration. So the three experts that we have with us today will make presentation for 1 hour in total on the said areas. After that, we will be moving for Q&A. So our audience can send their questions directly to me using this Q&A option available on the platform. And we urge the participants to mute themselves during the whole session. With that brief explanation, now I would like to invite Ms. Charmaine Tilakaratne to make her presentation on proposed changes to personal income tax regime. Considering the importance of this area, we have allocated half an hour for this session. Charmaine, over to you.
Thanks, Rakita. I'll start off by sharing my screen. Can you see my slides?
Yes, Charmaine, we can say.
Right. So, as summarized by Rakita, we will start with the personal income tax implications that are stemming from the proposed bill. And we'll quickly go through what are the significant changes. So to start off with, just to give a overall scheme of the act and regarding the changes and when they are effective, Some of these changes are going to be effective 1st of October 2022. Some are to take effect when the bill is certified, and some will be taking effect next year, 1st April 2023. Now, with any fiscal bill, when you bring in an amendment midway during the year of the fiscal year of assessment, there is always that difficulty of having to then divide your income and the implications thereon between two periods, the previous period and the proposed period with the new amendments. So, and for that reason, it's generally not encouraged to have legislation for changes in taxes to be brought midway during the fiscal year, but nevertheless, it has been done in the past, and it is also going to be done this time under this bill as well. So, due to the changes taking effect from 1st October 2022, the year of assessment for 22-23 will be divided into two periods, 6 months, 6 months. So 2 6 months period, and your income is supposed to be prorated between these two periods. So that is an overall scheme of the act and how it takes effect. So let's move on to the most talked about topic under this particular bill, and which is the impact this bill has on personal income taxation, the change in the rates and the tax-free thresholds and so on. So we'll start off with the personal income tax-free threshold. So currently at the moment, that is under the law that is prevailing right now, the personal relief or the tax-free allowance for an individual is 3 million for a year of assessment. Under the proposals that were submitted in the interim budget in August 2022 of this year, this 3 million threshold was proposed to be brought down to 1.8 million. However, this bill has gone one step further and has further reduced it to 1.2 million. So currently, the tax-free allowance is 3 million per year of assessment. It's going to be brought down to 1.2 million. So for the current year of assessment, that is the 22-23 year of assessment, as I mentioned before, we will break it into two periods, 6 months and 6 months. 6 months, the first 6 months will have the old law, and as a result, it's 1.5 million, that is half of this 3 million. And the balance 6 months will have half of the proposed law, which is 600,000, and that is half of 1.2 million. Now, in addition to this tax-free allowance, under the current law, an individual is also afforded what we call an expenditure relief. Expenditure relief is a deduction you get on expenditure incurred on certain heads, namely for health insurance, education, housing loan, investment in the stock exchange, investment in government securities. So there were certain expenditure relief that was given as a deductible expenditure in addition to this 3 million tax-free allowance. So that was 1.2 million. Now that has been taken off effective 1st October 2022, right? So for the first 6 months, you'll get 600,000, which is half of this. Effective 1st October 2022, that expenditure relief goes off completely. So you will not have the benefit of that expenditure relief. However, there is also a qualifying payment relief which is available at the moment for investment in solar, your rooftop solar, where you provide electricity to the national grid. So an investment made in installing this rooftop solar or a loan taken to fund this investment in rooftop solar can be, the interest component can be deducted as a qualifying payment relief of up to 600,000 per year of assessment. That will continue. So you will continue to enjoy that relief. In addition, there is a qualifying payment relief of 25% rent allowance, which is given where you have rent income. You can either claim your actual repairs and maintenance cost, or you can get as a deduction 25% of allowance on your rent as a deduction. Right. So if you go for the actual, of course, you have to be able to prove it through the expenditure incurred and the relevant receipts and so on. But this is an allowance, 25% allowance on your rent, and as a deductible expenditure that is still there and will continue. The next change, the significant change is, of course, to the tax rates and the tax slabs, which again is a much talked about topic these days. So under the prevailing law, we had 3 million slabs for your income tax rates, starting from 6% and going up to 18%. So the slabs were 3 million each. Tax rates are starting from 6% going up to a maximum of 18%. Now, in the interim budget, again, which was presented in August, which made reference to the proposals made in May, these slabs were proposed to be reduced to 600,000, and the tax rates were going up to, I think, a maximum of 30%. But with this bill, again, they've gone one step further and further reduced these slabs. So now the slabs will go down to 500,000 each, right? So from 3 million, it goes down to 500,000, and the tax rates will start at 6, but will go up to a maximum of 36%, right? So again, because of the introduction of the law midway during the fiscal year, we have the 2 periods. So the first period will carry the slabs of the currently prevailing law, which is 1.5 million, that is half of the 3 million. And the next 6 months will contain the slabs at 250,000, which is half of the 500,000, which will be effective from fully effective from 1st April 2023. So this change will take place from 1st of October 2022, right? So it goes up to 36% from current 18%. There's a jump of up to 36%. So just to give you an idea of how this is going to impact your monthly income, the tax. There's a table here which shows the monthly salary in this column. If you're earning 100,000, you will not pay tax. That's your tax-free allowance, 1.2 million divided by 12 months, 100,000 per month, and you won't get taxed. Anything above that, you start to be taxed. And as you can see here by the percentage increase, those in the lower income brackets will feel it more. The impact will be more, as in the increase is much more greater than those in the higher income brackets. But all in all, everyone has a significant increase in their tax liability. And there's also a significant change to employment income. So under the current law, effective 1st January 2020, taxation of your employment income at source was taken out. There was no tax at source on your employment income, which was then called PAYE, pay as you earn taxes. It was abolished effective January 2020. And a provision was brought in where taxes can only be deducted at source by the employer if the employee requests that deduction to be made. Unless, of course, you're a non-resident. If you're a non-resident or a non-citizen of Sri Lanka, that deduction at source was mandatory, even currently is mandatory if you are a non-resident or a non-citizen. But if you are a resident of Sri Lanka, APIT or the payee, which is deduct at source, was not mandatory. It was only upon the request of employee. Now, effective 1st October 2022, they are bringing back the mandatory deduction of taxes at source on employment income, which is called APIT. Right now, it's called APIT. So, an employer is mandatorily required to deduct taxes at source on employment income. However, there's a little gap here in the chargeability and the deduction. The deduction can only take place once the bill is certified by the speaker. So that is at a future date, but the chargeability is effective 1st October. So there is a gap, and of course, October salaries would have most likely, now today is the 21st, most likely will be paid, either has already been paid out or will be paid within the next few days. So October salary deduction, APIT won't take place until the act is certified by the speaker. In such an event, if it is certified at a future date, the taxes applicable to the month of October has to be collected, and one of two ways can be proposed for this. One is that the Inland Revenue Department might issue instructions to say that the employer can deduct the taxes applicable for the month of October, the additional taxes, over a period of 3 months or 6 months or whatever. Or they might ask the individual employees to declare it as their part of their personal income and pay taxes. We'll have to wait for an instruction on that. But until the bill is certified, employers cannot deduct the APIT in relation to the employment income. The taxation of terminal benefits, by and large, remain unchanged. The concessionary rates of tax on your terminal benefits will continue. There is no change from the prevailing rates. Then capital gains and other specified income. So your capital gains or gains from the realization of investment assets, which we commonly call as capital gains, is currently taxed at 10%, and there will be no change to that. That will continue under this bill as well. Any income that you derive from betting and gaming business or liquor, import of liquor, tobacco, or manufacture and import of liquor, tobacco, is currently taxed at 40% and will continue to be taxed at 40%. And under the bill, there is no change in that. Under these two industries, that is in respect of gems and jewelries, and where you provide supply electricity to the national grid, up until 1st October 2022, we are currently enjoying a 14% concessionary rate of tax that will be withdrawn effective 1st October 2022. Okay. Partnership tax, again, there is no change from the current law. Under this bill, there is no change. With respect to trusts, charitable institutions, there is no change, but unit trust and mutual funds, you can see that the rates are increasing again effective 1st October 2022. It will be going up from 18 to 30% in case of trust, in case of unit trust and mutual funds from 24 to 30%. And in case of an NGO, from 24% to 30%. 24% is the standard rate of tax under the current Inland Revenue Act, which is in force. Your employee trust funds, provident funds, pension funds, the taxation there will not change. The rate will not change. It will continue as is. Now, just to move on to a few exemptions of relevance for this forum and individuals who are in this forum. I've given everything here, but I'll just speak about what I think is relevant. Now, the export of services, what we commonly refer to as export of services, but which is where a person in Sri Lanka provides a service to a person outside Sri Lanka, a person being, it could be an individual, a partnership, or even a corporate entity. So a person in Sri Lanka providing a service to a person outside Sri Lanka, where that service is utilized outside Sri Lanka, and where you get paid in foreign currency for that service rendered, and that money is remitted back into Sri Lanka. That the income, the profits you derive from that particular service is currently exempt from income tax. Okay, it's currently exempt, and that exemption will continue. There is no change to that exemption. That is going to continue. So those of you who have enjoyed this exemption will continue to enjoy it. Similarly, there is currently an exemption on foreign sourced income. So any income that is foreign sourced, where you remit the money back to Sri Lanka, also enjoys an income tax exemption. That will continue. There is a specific exemption given to those in this IT sector, IT and BPO sector, either as consultants or as a corporate entity or as a partnership. Specific exemption was given to this industry, and what is information technology enabled services was defined in the Gazette under the regulations under the Inland Revenue Act. That exemption has been withdrawn, right? So their local earnings will now henceforth be taxed at 30% effective 1st April 2023. But where this sector can also enjoy the exemption under the export of services section, that they can continue to enjoy, right? So this is a big exemption that everyone was concerned about, whether it would be withdrawn. It has not been withdrawn, and it's very relevant to the legal profession, and can continue to enjoy that. There are certain other exemptions that have been listed out here on vocational education programs, export of gem and jewelry, sale and exchange on land to a listed real estate investment trust, renewable energy, projects of recycling construction material, and so on. All these enjoy exemptions which have now been withdrawn, and effective 1st April 2023, they will all be taxed at 30%, right? So these are again some other exemptions that have been withdrawn, not really very individual in a personal income tax capacity, but agro farming, that is your agriculture, where you have estate and you have agricultural produce, that will continue to be exempt. It is exempt right now and continue to be exempt. Agro processing, if you have any income from agro processing, that is where you take the farm produce and you further process it into other products, then that part of the income will not be liable at any concessionary rate. It will be taxed at 30%, right? But agro farming per se, it will continue to enjoy an exemption. Then dividends. Again, dividends is an area which individuals are very much concerned about. So right now, dividends declared to non-residents are exempt from income tax. That exemption will be withdrawn effective 1st October 2022. Dividends paid to residents will increase. The tax rate will increase from 14% to 15%, but it will be a final withholding tax, right? Currently, there is no withholding tax at source on dividends declared because it was abolished effective 1st January 22, 2020. All withholding tax provisions were withdrawn, but they're bringing it back now effective 1st October 2022. So dividends will be subject to a 15% tax at source, and it will be a final tax. Pass-through dividends, which is where you receive dividends out of dividends declared, is currently exempt and will be continued to be exempt, provided, of course, the first leg of the transaction, the first declaration of the dividend, is subject to withholding tax, which is actually called now advance income tax. It's the same meaning. The nomenclature is different. Then there are certain dividends to shareholders who are engaged in hub activities under the Finance Act that is exempt under the current law, and that will continue. If you have dividends from any foreign companies where you have shareholding in foreign companies, that will be exempt. It's currently exempt, and that exemption will continue. Dividends from a real estate investment trust listed in the Colombo Stock Exchange currently enjoys an income tax exemption, but that will be withdrawn and it will be subject to a 15% first and final tax. Again, this is also another area of interest to personal income taxation, that is the gains from derived from the sale of listed shares. That will continue to be exempt. But gains on realization of units, which are part of the real estate investment trust and listed in the Colombo Stock Exchange, that exemption will be withdrawn and it will be taxed at 30%. But shares listed in the Colombo Stock Exchange is currently exempt, and that will also continue to be exempt. Then your gain on sovereign bonds, that is your SLDB, Sri Lanka Development Bonds, will also be exempt. Then similar to the dividends on foreign shareholding, if you have shares in a foreign company, in an entity outside Sri Lanka, and you sell those shares, the gain on the realization of those shares is currently exempt and will continue to be exempt. There is no change there. Now we'll move on to the interest component of an individual taxation. So under the interest also, before I take you to the detailed slides of each type of interest or each different type of deposit and so on, in general, your foreign currency deposits, which you have opened in any commercial bank or financial institution, which are approved by the Central Bank of Sri Lanka, in general, any of those interest incomes will continue to be exempt. It's currently exempt and will continue to be exempt. So you have your sovereign denominated bonds, that is your SLDBs, will also continue to be exempt. In addition to that, there is currently a provision which says that a non-resident person, a person outside Sri Lanka, providing a loan to a person in Sri Lanka and gets interest on that loan, that the said interest will be exempt in the hands of the non-resident person. So that exemption will also continue. Obviously, the intention there is to draw foreign funding into the country. So these are all, again, these foreign currency accounts I mentioned. There are different types of accounts, special deposit accounts and so on. All the interest there is exempt. There is no change to that. In addition, if you are a charitable institution and you are and there is interest accrued by a charitable institution solely applied for a charitable purpose as prescribed, the interest income of that will also be exempt. And interest accruing to a welfare society, that is a society set up for the benefit of their members, the interest by that welfare society will also be exempt, and welfare society is defined in the Inland Revenue Act. Before I move on to the tax deductible expenses, I just might as well finish off the interest in relation to your government securities and so on. Right. So currently at the moment, as I mentioned, in effective January 2020, there has been no withholding on any form of interest paid. But now, effective 1st October 2022, the withholding tax or advance income tax has been reintroduced, and that is mandatory. So any interest or discount, there will be for a resident person, there will now be a withholding tax at source at 5%. It is not a final tax. You have to aggregate it as part of your sources of income and then pay tax at progressive rates going up to 36%, and you will get a credit at 5%, right? In case of a non-resident, the current law is that it is a 5% first and final tax. The 5% is subject to the double tax treaties. That will not change. It will continue. It's a first and it's a final tax. But for a resident, it's not a final tax. You have to add it on to your sources of income and pay taxes at progressive rates. So here are 2 points, a few points to note. One is that in the those of you who are below the tax-free threshold, that is 1.2 million for a year or 100,000 per month, if you are below the tax-free threshold, the 5% deducted at source can't be recouped by you, because the only way it can be recovered is if you file a tax return and claim it as a refund. But since you are below the tax-free threshold, it is unlikely that you will be able to open a tax file with the Inland Revenue Department. And since there is no direction mechanism under this act, unlike in the 10 of 2006 Act, where we gave room for you to go to the department and get a direction to say that you are below the tax-free threshold and direct the bank not to deduct the tax at source, that provision is not available in the current act. So since that mechanism is also not there, this 5% will effectively be a final tax for those of you who are below the tax-free threshold on all sources of income. Okay. Then interest on government securities, again an area of interest. Questions have been asked on how this is going to work in the future. So currently, interest on government securities are not liable to withholding tax at source. In case of a resident person, you are supposed to declare the interest income and pay taxes at progressive rates if you are, of course, above the tax-free threshold. That has not changed. That will continue. So there is no withholding tax on your investment in government securities. But if you are above the tax-free threshold, you have supposed to declare it and pay taxes at the applicable progressive rate, going from 6 to 30%. Okay. In case of a non-resident, there'll still be no withholding tax as is currently. Then you have withholding tax again brought back on certain payments. So prior to January 2020, certain payments, certain sources of payments were subject to a withholding tax at source. Some were final, some were not. So they've brought this concept back in with this bill. And so these are some of the things that I've listed out here. For instance, any rent payments which are more than 100,000 will now be mandatorily subject to a tax at source of 10%. It's applicable to any resident person. And again, you have to declare the rent income as part of your sources of income and pay tax at the appropriate rate. And you get credit for this 10%. Okay. In case of a non-resident person, it's a 14% tax and it's a final tax, subject, of course, to the double tax treaty provisions. It will be a final tax. Then dividends, I already took you through. There are other specified payments like on natural resource payments, royalty or premium. So again, in case of a royalty, natural resource payment or premium, in case of a resident person, there is a 14% mandatory deduction at source. You get a credit for that. You declare it as part of your income, pay tax at progressive rates, and you get a credit for the 14%. It's not final. In case of a non-resident, this 14% tax deduction is there. It's a final withholding tax. Subject to the double tax treaty and again subject to being within the thresholds and so on. This is going to be relevant to us, those of us in the legal profession. Again, the fee payments, your service fee payments. This was there before January 2020, where service fee payments paid to a resident individual who is not an employee. It's only applicable to a resident individual who is not an employee. Again, this will be subject to a 5% tax, mandatory tax at source, where you have to then declare it and under your normal sources of income, pay tax at the progressive rates and get a credit for this 5%. So here again, those of you who have say 100,000 rupees a payment in one particular month for more than 100,000, that may be subject to the tax at source. But thereafter, if you are below the 100,000 and in total for the year of assessment you are still below the tax-free threshold, any tax that was deducted on that 100,000 payment will be lost. It will be a final tax. There is no way to recoup it, right? So you have to be mindful of that when you are if you are below the tax-free threshold. So it's applicable to teaching, lecturing, independent service providers, doctors, engineers, lawyers. So that's where we come in, right? In case of a non-resident where we make a service fee to a non-resident person, it is a 14% tax first and final, but that 14% tax is subject to the double tax rate, PE and business under the Article 7 business profits article and so on. Subject to that, it's a 14% tax, and if it is deducted, it's a final tax. Same with the insurance premium payment made to a non-resident. So let me go back to on the deduction of expenses in determining your assessable income, the changes made to deduction of expenses. So I've right now taken you through the tax-free thresholds, your tax rates, the withholding tax implications on employment income, interest, and other service fees. Now we are moving to a section on deduction of expenses in determining your assessable income. Few changes, only the changes, and changes as applicable to individuals is what I'm highlighting here. So one change you need to be cognizant of, and that is on the losses. Currently, it's actually brought in as a qualification. It's brought in retrospectively, and it is actually a relief. So this, although brought in retrospectively, is a relief to you. Currently, it says that the law says that if you have losses incurred from activities which are taxed at concessionary rates, you can't set it off against the profits earned at tax rates at higher rates, right? So if you have incurred losses against a business activity which is at 14%, you then can't set off the losses against a business profit earned at a rate of 24% or 30%. But they've brought in this clarification to say now you can do that. The brought forward losses where it was incurred at concessionary rates of tax can be set off against subsequently increased tax rates. Okay, so otherwise this would mean that people, as a result of this amendment that is going to be effective from 1st of October, people would not be able to recoup their brought forward losses. And as a relief, they've brought it, and they brought it effective April 2018. Then another change that you need to be cognizant of is the gain from realization of your investment assets. So a gain from the realization of an investment asset is defined in the Inland Revenue Act. This is what we commonly call as our capital gains. A gain from the realization of investment asset cannot be reduced by any loss. Okay, so the gains are taxed, the losses you can't set off. Then not a change to the partnership income taxation. It's not a change, but again a clarification to make things a little bit more clearer, and it's effective 1st April 2018. Partnership income from your partnership for a year of assessment is meant to be it's business and investment. They've brought in a clarification to say it's also other income. So partnership income for partnership for a year of assessment shall be the partnership's income from its business, investment, or other income as well, right? So not just restricted to these sources, but now they've added the catch-all third source as well. And that is effective 1st April 2018. That, in summary, is the changes to the personal income taxation area. I'll be happy to answer any questions during the Q&A session.
Thank you very much, Shamin, for that in detail explanation. Now I would like to invite Mrs. Tanuja Pereira to make her presentation on proposed changes to corporation tax regime. And for that, we have allocated 15 minutes. Tanuja, over to you.
Thank you, Rakita. Good evening, ladies and gentlemen. I will take you through the changes made to the corporate income tax. Most of the areas were clearly touched by Charmaine, so he made my job easier much. And if we see the changes made to the corporate income tax, basically 3 areas. Most of the almost all the sector-specific exemptions and concession tax rates were taken out. And the tax rates have been revised. And there are a few administrative amendments as well. When it comes to the rate changes, you know that income tax rate applicable for the corporate sector reduced largely by the last year's amendment. That is the amendment introduced in 2021. By that amendment, the standard corporate income tax rate was made 24%. Before that, it was 28%. But with this bill, the standard income tax rate again increased to 30%. So, any company which was taxed at the rate of 24% will go up to 30%. Not only that, there are a number of sectors which were taxed at the lower rate. If you take manufacturers, the profits of manufacturers were taxed at 18% rate, and the exports, it was 14%, and both direct and indirect exporters. And SMEs, the applicable rate was 14% up to 30th September. And tourism, construction, health, agro-processing, all these areas, education, all these profits from all these sectors, corporate rate was 14%. Now, across the board for everyone, the standard income tax rate of 30% will be applicable from October 1st, 2022. So, when the return is filed, when the installment payment is made on February 15th, because the payment of the quarter commencing from 1st of October and ending on 31st December falls on the first, that is the third installment. It falls on February 15th. So, if anyone has this, the corporate income supposed to be paid at the rate applicable from October 1st, adjusting this rate to be paid on 15th of February. And the income tax rate applicable for betting and gaming and the liquor tobacco sales, that was 40, and it will be continued at 40% rate. Capital gain tax. The realization of investment assets, the gain from the realization of investment assets, taxed at the rate of 10% for everyone, even individuals, partnership, the trust, for anyone, the rate applicable was 10%. But in the case of corporates, with effective from 1st of October, the capital gain tax rate applicable will be 30%. So now, whenever there is a capital gain in the corporate company, if a capital gain is earned by a company, the tax rate will be 30%. They can't claim the 10% tax, but still the associate companies, where there is a provision to exempt the gain will be zero when it is transferred between associated companies. So that provision is remain, and it is more clarified with given redrafted with the clarity, and the exemption applicable for on this related parties, though the associate undertakings, associated companies will be continued. And deduction for improvements. Improvement cost, if currently the prevailed position is that the improvement cost is added to the written down value of the asset. From that, the depreciation allowance will be given. Since there is no way to give the improvement cost in case where the asset is fully depreciated, that issue has been addressed here by allowing the class 4 assets. When the asset is capital allowance on that particular asset is fully claimed, if it is a class 4 asset, that is a building or a fixed asset, then that can be claimed within 12 years period. All other assets falling under the other classes like vehicles, furniture, fixtures, and everything, machineries, the applicable capital allowance rate is 20%. That is depreciated within 5 years. If the asset is fully depreciated or the capital allowance is fully claimed, then these assets, the improvement cost of the asset could be claimed within 3 years time. And the capital allowance, these are administrative arrangements or the provisions which are to prevent manipulations and overclaim of capital allowance. So the capital allowance has been limited to the cost of the depreciable asset. And loss from businesses, and this was clearly explained by Charmaine. If the company's income taxed at a lower rate and subsequently rate was increased, let's say if a education institution which was taxed at 14% incurred a loss, Act provides that loss incurred at a lower rate cannot be claimed against a profit tax subject to tax at a higher rate. So that provision is amended to give the opportunity. The education business is the same, simply because the statutory provision, the rate increased, they will not be able to claim the loss. So therefore, even if the income is taxed at higher rate, the lower rate all will be considered at the higher rate. We also will be considered as lower rate. So the rates will be treated as equal to avoid any unclaimability of losses. Where the business nature, the business sector or the business profit has not been changed. And if you take the exemption, this is also discussed, a dividend payment, that is redistribution of dividend. If a company distribute a dividend which has been received by that particular company, that dividend will not be liable for withholding tax or not become a part of the liable income of the recipient company. So that provision was there, and it will be continued to be, the exemption will be continued. And removal of exemption, this is actually all these exemptions were given by the last amendment, and they were effective from 1st of April 2020. Now the companies who earn these type of profits could only claim the exemption for only 2.5 years, 2020, 2021, 21-22, and 22-23, first half of the year of assessment. So dividend paid by a resident company to a member who is a non-resident person is exempt, but was exempt, and that will be liable for tax with effect from 1st of October. And this reads, the investment, the transfer of asset to a real estate to a REIT by an investor, and the realization of units, both were exempted, but those exemptions has now been taken out. This was last year introduced, but I don't, to my knowledge, still these REIT activities has not been started. So any company who was willing to engage in this REIT activity upon this exemption has now, since the exemption has been withdrawn, we'll have to reconsider these things. And information technology and enabled service, there are a whole list of services gazetted by the Inland Revenue describing what are the enabled services. So the exemption granted for IT and these enabled services also taken out. Vocational education programs by any vocational education institution and the export of gold, these things applicable equally for companies and the individuals as well. So during the chairman's presentation, these were discussed in detail. And with effect from 1st of April 2023, that is these removal, the exemption removal will be applicable from the year of assessment 23-24. Because these are time bound. I mean, they are the Act gives a limited period to enjoy the benefit. So these benefits have been taken out with effect from 23-24 year of assessment. So that was applicable for construction material, the undertaking involved in the sale of construction material recycling, and businesses commenced by that is for the individual. The manufacturing boards, these things, actually very few people given for very few key people who companies who were registered with the BOI and had agreements with the BOI. This renewable energy project exemption was granted, and with effect from 23-24, these exemptions will be taken out. And installing communication towers, warehouses, and bonded warehouses in the Colombo and Hambantota ports given exemption. All these exemptions were now being taken out. So these exemption removal and the rate increases all will be applicable with effective from October 1st this year, 2022. Unlike individuals, where, as Chairman explained, if an individual has income from employment, and if the employer, if their consent is not given to the employer to deduct their tax from the salary, then they have to declare the income and pay it at least by 15th February next year as an installment payment. But that difficulty will not be arise for the companies, since they are installment payers, and they can adjust their tax payment and make the correct payment on 15th October. But the thing is, still this amendment is at the bill stage. Today it was presented to the Parliament and for the first reading, and it was taken for the first reading. And if the Act not challenged by any person at courts, then within another 2 weeks' time, we will be able to get this passed by the Parliament. Or if it is challenged by any person, then we have to wait for another 3-4 weeks to get the Act passed by Parliament. So that is the current status of the bill. So now from today, the period to challenge the bill is open, and hopefully we'll see the Act. When with this Act we can see the law in place. So that is briefly the changes introduced to the corporate sector. Thank you. Thank you all.
Thanks, Tanusha, for that brief but comprehensive explanation. With that, I would like to now invite Mr. Suresh Pereira to make his presentation on proposed provisions on tax administration process of the country. Over to you, Suresh.
Yeah, good evening, everybody. Let me thank the Bar Association for inviting me to address this webinar. And I also have a set of slides, and let me share that set of slides, and then we can start. Right. I hope you can see my slides. I won't take much. I'll just go through the certain amendments in relation to the administration of the Act. So a few points I'll touch on. Some aspects with regard to the computation and the set form and the right to amend the self-assessment return, what will change there. And there's a new provision with regard to empowering to obtain information for the by the Commissioner General. And briefly, I'll touch on the assessments and the appeals process also. Right. So, with regard to the computation, what do we see now? As Shaman pointed out, these revisions are being introduced in the middle of the year. So, this happened once upon last time also, and we have a precedence in relation to this. So, year of assessment, income tax is computed for an year of assessment. So, what is an year of assessment? Year of assessment is the period commencing from 1st of April to 31st March, a 12-month period. Now, if you take the VAT is calculated for a quarter or for a month. So that's called the taxable period. Now, this when you introduce changes in the middle of a taxable period, there is a problem, because normally you calculate your taxes for 12 months, and then there are certain allowances that are given, and all are given basically for a period of 12 months. And expenses incurred, the income income attributable to that 12-month period, etc. You have to get to calculate the taxable income. So now, when in the middle of the year, taxes are the changes are introduced, how do you do it? So there are no, how do I say? It creates a complicated situation. So in order to address the complicated situation, here there is a small rule that is given saying that, okay, take the first 6 months, that means from period from 1st of April to 31st September as the first period, and from 1st of October to the 31st March in the subsequent year as the second period, and then calculate the taxes for year of assessment 22-23 on that basis. So in other words, now in this, here there is no express reference to say that first 6 months are considered as an year of assessment, second 6 months are also considered a year of assessment. That it's not the wording that has been used, but it is what is being tried to, it is what the bill is trying to achieve. Why I emphasize this aspect is, in this, if you are a lawyer now, when you're going through the Act, you'll see in another section, there's a specific reference to consider period prior and the period after as deemed years of assessment. It is not the wording that is used here, but the effect is nevertheless is the same, right? So what will happen? So in relation to, if you take an individual, our first 6 months, that is from April to 1st of October or the 31st September, we have the normal tax rates. So what are the normal tax rates we had earlier? 6, 12, 18 continues. And the allowances, certain allowances that we had, personal relief, etc., now have been prorated for 6 months. So what used to be say 3 million, or rather say 1.2 million expenditure relief, there's a reference to say take a half of it, so 6 lakhs. So likewise, how to calculate, there are certain guidelines that have been given. So the second 6 months, again, the rates change, the slabs change. So for second 6 months, the rates are going to be 6, 12, 18, 18, and then 24, 30, and 36. The slabs also change. So basically you have to do a two calculation. So it's going to be a little bit complicated for a normal taxpayer to do the calculation in this manner in relation to the year of assessment 22-23, right? So the same rules will come in relation to a company also. 6 months, you have to do the calculation. So in this slide, I have given how that split is to be carried out with regard to the first 6 months, how it's going to happen. in relation to a company, right here. And for the second 6 months, what other rates to be used? If it is the standard rate, now there are 3 types of rates that are applicable for a company. You have the standard rate and the concession rate and the higher rate. So for this first 6 months, in relation to the standard rate and the concession rate, there's going to be a change. Whereas in relation to the sin industries, which are taxed at 40%, that rate change that won't happen because the rate 40% has not changed, right? So what's going to happen for a corporate that was enjoying a 24% rate, and you can see this the column on the right hand side. This 24% here is for the first 6 months, it will continue as it is, but for the second 6 months, since the standard rate going up to 30, it becomes 30. For companies that were enjoying 14%, for the first 6 months, it will remain at 14, but going forward, it's going to be gains from so manufacturing companies which enjoyed 18% for first 6 months, they will also continue to have this 14 and the 18. But when it comes to the second 6 months, it's going to be 30%. And personal income tax, this is something that we all interested in. The not prevailing rates, as I mentioned, and you can see the slabs are 3 million slabs. And how is that going to change with the bill? So according to the bill, again, for the first 6 months, for the period that I mentioned earlier, April to September end, these existing rates could be used, and this 3 million is prorated and given as 1.5 million. So, and the expenditure relief, which is 1.2 million, which I explained the 5 types of expenditure that is there, it's also prorated, only 6 lakhs given for the first period. So when it comes to the second period, personal relief is 6 lakhs, and the rates are changing, and you can see the slabs are also changing. So the slabs for a year, the slab is going to be 5 lakhs. So here there are only 6 months. So it's each slab is going to be 250 because it's a 6 months period, right? So this is only for the year of assessment 22-23. When it comes to 23-24, it is straightforward. The new slabs, the new rates to be used directly. Another thing that we have to be mindful. Okay, now this is something interesting again for lawyers, right? Earlier slide was difficult computation. Maybe for accountants it's of interest, but if you're a lawyer, right? So basically under the new Inland Revenue Act, the things changed. Those days, a taxpayer had the obligation of the taxpayers was to pay on four quarterly installments, pay the taxes, and then on the 30th September pay the final payment, and thereafter file the return. And if a taxpayer had done that, then the taxpayer had discharged its duties by the state. But the new Inland Revenue Act, with effect from that was introduced with effect from 1st of April 2018, introduced the new obligation on the taxpayers. On or before the 15th of September, August, that is before paying the date on which the first installment payment to be paid, on or before that date, to file a document also. So that's a document showing what we call the statement of estimated income on the taxes. So it's a new obligation that we have to fulfill there. Now, with regard to that, there is a change that has been introduced, which was there. Because I can't say that it's a novel introduction, because it was also there. This power to the Commission General was also there, but now that power has been changed, or rather has been devolved and given to assistant commissioners also. So what's that? So every taxpayer before 15th of August had to file this set form reflecting or giving an idea with regard to the taxes the person has to pay. And now, and at that time also, the Commissioner General had the power to tell a taxpayer, wait, now you don't have to do that thing on your own. I will tell the taxes that you have to pay and issue the estimate for you. And then the taxpayers have the obligation to follow that estimate given by the Commissioner General and pay the taxes according to the estimates specified by the Commissioner General. Right. So this is the existing law. This is not the new change. Now, what is the new change? So now here, if a person has failed to file a set form, so most of us, okay, we may pay the taxes, we may file the income tax return, but we won't file the set. Now, if we have failed to do that, now set is also considered a return, right? So that's something that you keep in mind. So if you have failed to file that set, or we have filed the set and the amount that we have reflected in the set as the taxes payable is less than the previous year's payment. If that's the case, now power has been given to an assistant commissioner to, now earlier it's the assistant, this is the Commissioner General. Assistant commissioner has been given the power to tell and issue to tell the taxpayer, okay, I will basically now tell you the estimate, your estimate I will make, and you have to pay taxes accordingly. So the wording in the law is the assistant commissioner may serve an estimate of tax to such person, stating the estimated tax payable by such person. See, now he has been given the power to tell the taxes that you should be paying. So this is not a case of self-declaration where basically we calculate our taxes. The Commissioner General is telling the taxpayer, this is the amount that you should be paying. Estimate tax payable by such person for the year of assessment based on such evidence. So he can't do that thing according to his whims and fancies. He must have some sort of evidence. Based on its such evidence as may be available according to the best of his judgment. So there are two aspects here. Earlier, the power that was with the Commissioner General now has been given to Assistant Commissioner. So who are the Assistant Commissioners at the Inland Revenue Department? Those days we had those officers called assessors. And there's a change that happened somewhere in 2014, and all assessors became assistant commissioners. So you can see this is how do I say, in the hierarchy at the Inland Revenue Department, the assessor level or the lower level, right? So this level of people who are handling our files directly now has the power to go ahead and tell us, okay, this is your estimate. You shall pay taxes according to this estimate based on the evidence. So now, once we get this, so this is a kind of a draconian power that has been given to an assistant commissioner, because once he raises this set, once he issues this set, we are bound by this estimate and pay the taxes accordingly. Now, if the so that's a condition. Basically, when can the assistant commissioner make this estimate? He can make this estimate after the first installment date, but before the final installment, fourth installment date. So now the installment dates are basically first installment is the 15th August and the final is on the 15th May. So in between this period, he can go ahead and do the estimate for any taxpayer, and then we have to pay taxes accordingly. So the interesting question is, once this estimate is served on us, what are the rights that we have? Now, when an assessment is served on us, what do we do? Under the New Inland Revenue Act, we have to go and ask, we can request for an administrative review. So what we have is, now is not the concept of appeal to the appeal against the assessment raised by the Commissioner General. What we have now is a request, the right to request for an administrative review against the assessments that are being raised. Right now, when we receive a estimate, now estimate is not an assessment. What can we do? Interesting question. Right. So I think now this is Right, so I have reproduced this section 139. The wording in this section is interesting in relation to this question that I'm raising, right? A taxpayer who is dissatisfied with an assessment. A taxpayer who is dissatisfied with an assessment may request the Commissioner General to review the decision. So this is what we call the administrative review, the right to request for an admin review. Now, in that section, there is this phrase, other decision. So a taxpayer who is dissatisfied with an assessment, so estimate is not an assessment or other decision, may request the Commissioner General to review the decision. So I think basically going forward, we can ask for an admin review against an estimate raised by an assistant commissioner also. So because of the wording that we have here, it's not just the assessment. The Parliament has specifically said assessment or other decision. So this estimate made by an assistant commissioner, in my view, is then will fall within the ambit of this phrase other decision. So that will trigger us the right to request for an admin review against that. And if once the admin request for an admin review is made, and once after the determination given by the Commissioner General or after the period, the statutory period within which, if no determination is given, we get the right to go to the Tax Appeals Commission by way of an appeal, to the Tax Appeals Commission. So I am inclined to think in relation to this estimate also, that same process should be established because of the way the law is worded, right? So let's keep our fingers crossed to see how this matter will get resolved there. Right. While I'm in the section 139, I will also point out another admin change that has been introduced in this bill. Now, normally, even under the old Indian Revenue Act also, when assessment is raised, we get a 30-day period to appeal under the old Indian Revenue Act. Under the new Indian Revenue Act also, when an assessment is raised, you have a 30-day period to request for an admin review from the Commissioner General. Now, this 30-day period is coming from the 139 subsection 2, and you can see it here, is being changed. And this 30 days is getting reduced to 14 working days. The law specifically uses the working day concept here. So just 14 days. And when you look at it's the time that we have to make a request when we get an assessment is getting reduced to 14 days. Now, what we have to keep in mind is the structure of the drafting will just mean that when an estimate is made also, we have only a period of 14 days to request for an admin review in relation to this also. Right? So just keep in mind, so it's a draconian, how to say, not a draconian, very unfair change that has been introduced, because the period that we have to ask the admin review is reduced to 14 days from the 30 days. So these are the points that we have to keep in mind. And this right to this right to raise an estimate given to an assistant commissioner, as I mentioned earlier, comes under, there are on two occasions, two incidences can trigger that. If you have failed to file the estimate the set, or if you have the amount that you have reflected in the set is lower than the previous year's tax payment. So what does that mean? The policymakers have considered that all taxpayers will have income being increased year by year. Year on year, income of a taxpayer is getting increased. That's the expectation there. So which is again not a very fair expectation. But if the amount that you have shown is less than the previous year's tax payment, then okay, we should be ready to get a estimate from the assistant commissioner. Right. Another change that we see, the number of the power to amend the returns. Now, under the old Inland Revenue Act, we did not have a section in the Inland Revenue Act empowering a taxpayer to amend the return. It's administratively with the concurrence of the Inland Revenue officers that we amended the return those days. But with the introduction of the new Inland Revenue Act, the things changed, and as a right, the taxpayers were given the opportunity to amend the returns, provided Commissioner General accepts that amendment. Right? If the Commissioner General had the discretion not to permit that amendment also. Now, the period applicable for, so that's the 136 that you have to go through to get to understand the current law. I won't go into the details, and that is being changed. So earlier we had 30 months to amend the return. 30 months. That 30-month period is being reduced to 12 months. So again, you can see the time that's there for the taxpayers to carry out this change, to make this request, are being curtailed by this amendment. Earlier the 30-day period for making requesting for an admin review was reduced from 30 days to 14 days, and here the right to amend the return, which currently is 30 months, is being reduced to 12 months. Again, we have to keep in mind, right? Another interesting change that has been introduced also. Now, the Commissioner General can request, make a request to the Elections Commissioner to provide names, addresses, and the NIC number, National ID Card number of persons. So new right being given to the Commissioner General by the bill. So notwithstanding anything to the contrary in any other written law, so that phrase is specifically there, the Commissioner General by notice can require the Commissioner General of Elections to provide the names, addresses, and the national ID card numbers of the persons as may be specified in such notice, and the Election Commissioner should furnish that information. Right. Not only to the Commissioner Elections, the Commissioner General's power has been extended to make that request to Registrar General of Companies also to ask for information in relation to companies as well. So, in relation to companies, the information could be in relation to the directors. That's what specifically mentioned there. Right. So, in addition to that, let's see what has happened to the appellate procedure. Right. So, under the current Inland Revenue Act, we have several types of assessments. What is called the self-assessment is the return that we file, and then there's a thing called advance assessments. If a person is planning to go abroad or for whatever reason, Commissioner General or the Inland Revenue Department can request a taxpayer to file the return before the 30th November, before the due date of the return filing, to furnish a return. So those are called, to basically raise assessment on that person. So that's called an advance assessment. Then there's something called default assessment. So what is a default assessment? If you have not filed the return, then the assessment that's being raised by the Commissioner General is referred to as a default assessment. Amended assessment is the concept. We have filed the return on the 30th November, and if the Commissioner General thinks that for whatever reason is not in agreement with the self-assessment or the return that we have filed, then he can come with the amended assessment, and within 3 years. And thereafter, if he finds that okay, he has missed out something, then he can, before the end of 4th year, he can also raise what is called an additional assessment. So there are two types of assessment: amended assessment and additional assessment. And additional assessment should always come after the amended assessment. Now, something peculiar that we have seen in the assessment process that was carried out recently in relation to the year of assessment 18-19 is the department raised additional assessments without raising amended assessments, which is not in accordance with the procedure in the law, which may result in these additional assessments that have been raised being held not valid if this matter goes to a court of law. That's what some of us are expecting, right? All right. Now, in a snapshot, I'm giving the idea with regard to the what an taxpayer can do, an aggrieved taxpayer can do when he receives any of those 4 types of assessments that are mentioned here, right? So the first, there is no appeal to the Commissioner General. What we have is now the first stage is called request for an administrative review. So basically there are 4 stages, right? And from there, against an admin, if the decision of the admin review is against the taxpayer, or the determination with regard to the request of the admin review has not been delivered by the end of the period, that means the 7 months, then we can go to the Tax Appeals Commission and canvass our case. And on a question of law, from there, against the determination of the Tax Appeals Commission, we can go to the Court of Appeal. And from Court of Appeals decision, again on a question of law, we can go to the Supreme Court as well. So that is the existing process that we have. So the change that is taking place here is this 30-day period that we have to make admin review, as I mentioned earlier, is getting cut down to 14 days. But I won't go to this one. So what is happening is, as I mentioned, the change is 30 days being reduced to 14 days. And I think those are the things that we have to be mindful. Again, for lawyers, again, 140 is important. That's the period that we have talked about. Yeah, so those are basically the changes that we have witnessed with regard to the admin provision, changes with regard to the admin provision. So with that, I think we can go for the Q&A session.
Thank you. Yeah, thank you very much, Suresh, for that concise explanation. Most of the questions that were raised initially, I can see that they have been withdrawn by the questioners because most of the questions have already been answered. However, based on the other questions that have been raised, I have summarized a few questions to the panel of members. Here, one question is, as per the proposed amendments, WHT is reintroduced on interest income at 5%. Does this apply only on bank deposits, savings accounts, interest income, or will it apply on interest income for treasury bills and bonds as well? That is one part of that question. And at the same time, they're asking if my total income for the year, including bank interest income, falls below this personal relief, which is 1.2 million, would the bank still deduct withholding tax at 5%, or is there provision for me to submit a declaration and avoid the WHT as we did under the previous Inland Revenue Act? I think this question has already been answered, but Shaman, if you can enlighten us further on this, that would be grateful.
So the first question was, if you can repeat that, Rakita?
Yes. Yeah. So it says WHT is reintroduced on interest income 5%. And does this apply to bank deposits and the savings account interest income, or will it apply to treasury bills and bonds as well?
Okay, so no, the withholding tax at source is applicable to all interest income from deposits maintained at financial banks and financial institutions. There is no withholding tax on the interest income from government securities, that is treasury bills and bonds. There is no withholding tax on applicable to those the income from government securities. You have to then declare it and pay taxes on it as with your deposit income. But 2 categories. So deposits from the banks and financial institutions, yes, there is withholding tax. Government securities, no, there is no withholding tax. And yes, that 5% tax on those deposits will be deducted irrespective of the threshold. The bank will deduct it. If you are below the 1.2 million, even they'll deduct it. And there is no direction mechanism for you to go and ask the banks to refrain from deducting, even if you are below the 1.2 million tax-free threshold. So that's why I said, for those of you who are below that threshold, effectively, it is going to be a final tax.
So they have
Shamin, please. Yes, sir.
Yeah, no, so I think our request in relation to this to Tanuja is to consider including include a direction mechanism, because whenever there is withholding mechanism is a good idea that suits Sri Lanka, but at the same time, whenever there is a withholding sections, withholding regime, direction mechanism should also be there. Otherwise, there will be a category that will face inconveniences.
I would like to add a word to this because if if you are below the tax-free limit and still the withholding tax deducted on your income, then what the person can do is to file a return, because we are discussing the discussions being now that has been discussed because to expedite the refund process, because these were we have lengthy discussions with the Inland Revenue as well to provide a mechanism to identify these people and refund them, because there is no way to avoid the withholding tax, no direction mechanism, because it is also a difficult task to get a direction and apply that. So it's not easy, and the trend is to take out all the discretionary powers. So without going for that, the person whose income is below the tax-free limit, what they're supposed to do is to file a return and claim the refund. So it is not final, Charmaine. It will not be final.
The problem there, Ms. Tanuja, is that the department will not allow you to open a tax file if you are below the tax-free threshold.
No, Charmaine, that these administrative things will be arranged. I mean, these things are being discussed. No, so these things will be done. I mean, once this act is enacted, the currently also it's been discussed.
Okay, but because right now they won't allow you to open the tax file if you are below.
I will look into
that and of course the refund.
Sorry, go ahead, Charmaine.
No, also the refund is, I mean, to be very honest, Mr. Mujay, currently is also very, very hard to get it. So if there is
so that's the issue. Nobody believes in refunds. So
yes.
That's the issue, main issue we are facing with. So no, anyway, because the thing is now every cent is get taxed.
But even earlier, Ms. Nanuja, even earlier under the old law, when they had 5% tax, that also was across the board to everyone, and those who were below the threshold who didn't file the return, it was a first and final tax for them.
They didn't claim, but the problem is, I mean, if the individual is a senior citizen, earlier they have given additional 1.5 million. Now the issue is this additional 1.5 million is taken out, so they also get the benefit of this 1.2 tax-free limit. That's the issue, here. So we are thinking of at least refunding that for the senior citizens if they are below the threshold.
Isn't it better to actually increase the withholding tax to 10% and bring in the mechanism, the direction mechanism electronically? That's not possible, is it?
The digitalization would be the answer for most of the issues. So we'll think of that, Charmaine. Yes.
I think, Shamin, you gave a very bad idea to increase the withholding tax to 10%, because most of the professionals like us will get affected by that. So that's the next question that I was going to raise, because now they have reintroduced this 5% withholding tax on specified service fees, including payments made to lawyers. Now, there was a question asked that is, these lawyers will receive payments from companies, other non-incorporated entities and individuals. Would this withholding tax occur when a payment is made by an individual, or only where the payment is made by a company?
If the payment is made by a company or a registered, I mean, the withholding agents only can deduct withholding tax, not the individual payments. So if it is a business, not only corporate, even if it is a non-cooperated business person, then that payment will be subject to withholding tax, but not the individuals.
Correct. It won't be from your one-off clients who are just individuals, they will not deduct it.
Yeah, then the other question that they have asked is a lawyer may receive multiple payments from the same party in a particular month, but all these invoices are below 100,000. But cumulatively, it exceeds 100,000. So in that case, this withholding tax be deducted.
Even if the because the payer, if the payer is the same, I mean, if the payer is the same person and in few installments within the month they have made, within the period they have made this full amount, then it will be subjected. Yes.
Because if I remember right, in the past, what happened was for each invoice, like, when they're raising the invoice, for each invoice, they consider whether it exceeds 100,000. Because for each invoice, they used to issue a tax withholding certificate for us to make a refund at the end of the day. So, but now here, that means the registered companies, I mean, these companies, when they're making payments, so they have to consider the cumulative amount.
Yes,
without considering each and every invoice.
Yes, other than that, they can't claim the deduction. I mean, they are claiming that expense from their income. So they will not be able to claim that if they don't withhold the payment. That's the issue.
Okay.
So it's a self-policing mechanism, Rakita. So if the companies deliberately know that in aggregate it's going to exceed 100,000 and they've not deducted it, they will not get a deduction from their side for that expenditure. So they will on their own make sure that they make that deduction. It's a self-policing mechanism.
Okay. Then there's another question. What type of expenses can an individual deduct from his income when arriving at his taxable income? His income can be from business, investment, or employment, or can be a combination of all three. Can an individual deduct personal expenses such as expenses related to health, education, bank loans, etc.? Now that was also answered, but if we can.
So those, yeah. Those the expenditures you just referred to were given as a special relief under an expenditure relief category that has been withdrawn effective 1st October. So those types of expenditure will not be able to deduct it going forward. Expenditure so in general, I mean, then now we are moving away from the new bill and going into the concept of what is deductible. But in general, any expenditure incurred in the production of your income, be it from business, investment, or other income, that is deductible. And of course, there are then again another section that goes on to give you specific expenditures that can't be deducted. It's given in the Inland Revenue Act. So there are non-deductible expenditures like domestic expenditure and so on. So within those rules, you can deduct the expenditure. But this particular expenditure you just referred to now is what we call their personal expenditures and their expenditure reliefs, which is going to be withdrawn effective 1st October 2022.
Yeah, and there's another simple question. I believe that it's a straightforward one. Do all individuals have to file a return of income even where you do not have any taxable income?
No, so you're supposed to file a return of income only if you exceed the taxable income threshold. But as we discussed earlier, now if you want to recoup your withholding tax and if the Inland Revenue Department permits you to open a tax file, even though you're below the tax-free threshold, you can voluntarily open that file and try to recoup the withholding tax that was deducted at source. But otherwise, chargeability is only where you exceed the tax-free allowance.
Okay.
I think that question is important what Rakita asked. Let me ask that from Tanuja also. There was a policy statement made by, I think, the highest in the land that anybody over 18 years must file a return. So where do we stand in relation to that?
That was not brought into the law.
Now the act permits the minister to get any class of persons within the tax system. That the provision is there in the act. So anytime by issuing a gazette notification, no, the minister can do that. But first we have to make the environment for that, because the information is supposed to be correct and updated. That's why the provision to collect information from the commissioner in election department is provided under the new the proposed bill. So the updated records and the updated database is available with the elections department. So the Inland Revenue Commissioner General is empowered, will be empowered to collect details from them. And this is not an opening of a tax file. It's a kind of record of every individual. I don't know how far it is possible to get all the 18 plus persons under the system, but still it will be a record. So going forward, the intention is to having this digitalized number where the transactions could be traced. So that is the whole idea behind this. And you know, and I have to say this, and every forum I emphasize this, because currently, if you take the last year 2021, at the end of the year 2021, we had only less than 500 taxpayers registered at the Inland Revenue Department. Individuals, payee liable, and corporates, everyone, including partnerships, less than 500,000. So can you imagine where we are? So we have to expand the base rather than going after the same taxpayer every year. So that is the whole idea. So, and I have to emphasize this figure. So we have to increase this number anyhow. That is it.
So what Tanuja is saying is that anybody who is turning 18 years need not go to the Commissioner General and say, take my details down. That the Commissioner General will do with the Elections Commissioner. And we don't have to worry about filing returns after the 18 years, no?
You're muted.
Yes, that is it. Yes, I of course, that is the idea. Because we are we don't have the capacity to get the open tax file for every individual. I mean, every 18 plus individual, we don't have that. We can have a, virtual record of that. Yes.
Yes, I would like to ask this. I have this personal question to ask from Ms. Tanuja. That is, you explained that you should not go behind the same taxpayers and you should be able to expand the tax base. But if you look at this bill, here you're actually squeezing the necks of the existing taxpayers. And Charmaine explained through her computations. And if you look at these changes, lower income, just above 100,000, the employees who are earning just above 100,000 are the people who are going to get affected the most here, if you look at it as a percentage. So do you think that this bill will help us to achieve what you said?
Rakita, currently we are in a crisis situation because we need the revenue. So this is not the time to bring the potential taxpayers and they get tax from them, because it's a regular process. I mean, we have to start it at least now. Right, but currently we need the revenue, and because otherwise, and I must explain that if you take the payee or the APIT revenue, advanced personal income tax revenue, more than 80% of the revenue is generated from less than 14% of employees of the higher level. I am not referring to the current situation. I mean, the situation prevailed prior to 1st of October. That is with the income tax-free limit of 3 million. I am talking about the situation prevailed at 18-19 year, where the tax-free threshold is the same for employment income. It was in 18-19, the tax-free limit for the employees was 1.2 million. And in that particular year, if you analyze, once I analyze the records, more than 80% of the revenue had come from less than 14% of the employees who are at the upper level. So that is the reality, Rakita. So anyway, we have to go with this to at least for the moment. I mean, we can't go now for the new tax, find new taxpayers and bring them into the system and taxing them. But we have to collect some mobilized revenue from the existing tax base as well. So that is the issue.
But have we made an effort to reduce the government expenditure? Yes, like I understand we need to have tax revenue to meet the government expenses. At the same time, don't we? Public
Rakita,
expenditure.
I don't have currently with me the expenditure records, but if you compare with the previous year, the expenditures substantially, I mean, the significant reduction in the expenditure as well. And it will be reduced much more going forward. I think we have to wait and see the coming budget, how the expenditure allocation is going to be. So we have to wait.
Actually, I asked those. Sorry,
Yes.
go ahead.
Yes, Rakita, yes.
Yes, no, I asked those questions because these days, these are the discussions that we have inside the courtroom, outside the courtroom, right?
Yes.
Because of these changes that the government is going to introduce. So, yeah, I understand that, right? Thank you. Suresh, I would like to you address on that estimate thing. So it's very interesting. You explain it very interestingly. Now, you say that the estimate made by the assistant commissioner, it is covered by the appeal section also, where you can, you can make a request for an administrative review. But don't you think that now, and they are going to reduce the time period for you to make that administrative review also to 14 days, 14 working days. But don't you think that it can be challenged by way of by invoking the writ jurisdiction of the Court of Appeal, as there is a involvement of judgment by judgment of the assistant commissioner?
Yeah, so basically, jurisdiction, as we all know, is basically open for everybody and anybody. And only sometimes, okay, when you go for a writ, if there's alternate remedy available, sometimes the judges take up the position. Yes, you need to resort to the alternate remedy without invoking the judges will be reluctant to grant writ. So subject to that, yes, basically you do have the right to go for a writ. I mean, even now, this is just not the estimate. Even normal assessments, when we receive under certain circumstances, we do invoke writ jurisdiction, notwithstanding the normal appellate procedure being available. And if we are successful in convincing the judge, the Court of Appeal judges, that granting a writ is the appropriate remedy, yes, notwithstanding the normal appellate procedure or the alternate process being available, we have been successful in getting writs also, yes.
And
Yeah,
I would like to add something, but Mrs. Suresh, and you clearly explained that. And now only I got that point. I mean, whether it could be reviewed, the estimate assessment, the set estimate, because what could be reviewed is an assessment and the decision of the Commissioner General. Since it is not the Commissioner General's decision, I thought I'm thinking of doing a correction there during the committee stage at least, because I feel that it does not cover the set estimate. Because anyway, the inland revenue officers can argue that this administrative review opportunity is given only to an assessment and the Commissioner General's decision. So
are we trying to say that the assistant commissioner's decisions have more powers than
no, actually what I thought of is to to give effect to appeal, giving a chance to appeal against that as well. I mean, intention is not that. That is why.
Yeah, absolutely, Ms. Karanja. If that can be granted, that will be.
No, see, my view in relation to that is, yeah,
yes.
my view in relation to that is different, because 139(1), the wording is a taxpayer who is dissatisfied with an assessment or other decision may request the Commissioner General to review the decision. So nowhere does it say that it has to be a decision made by a Commissioner General. It could be anybody, so it's open for interpretation, or it's any tax officer's decision could be a subject matter to the admin review by CGIR.
We'll see that. We'll look into that.
And there's I think it's not a question, but kind of a proposal, or else I think he's sharing his thoughts on this and directed to Mr. Suresh Pereira. He says, I think it's the question has been raised by Kentiran. In my opinion, the government must tax individuals not on income, but on expenditure. Individuals don't disclose income, but their expenses can be traced. In addition, they must also tax on their assets. What's your take on this, Mr. Pereira?
Okay, tax on the assets, yes, that's what we call the property tax. And from time to time, we have seen certain taxes in relation to owning property. And okay, we are expecting wealth tax also to come. I don't know, Tanuja must be able to tell us more on that. With regard to the concept of taxing the expenditure, I think nowhere in the world that concept is prevalent.
Okay, thank you very much. I think with that, we can wrap up this session. So I would like to thank all the members of the panel, Mr. Suresh Pereira, Mrs. Tanuja Pereira, and Mrs. Shamen Tilakaratne, for sharing your insight on this proposed Inland Revenue Amendment Bill. And finally, I would like to take this opportunity to thank the President of the Bar Association of Sri Lanka, Mr. Salih Piris, President's Council, and also the Secretary of the Bar Association, Mr. Isuru Balapatapandi, for arranging this important webinar session. And I would like to thank Mrs. Nikini Mapitigama, who coordinated this session also, and all the participants actively got involved in this session. So thank you very much, everyone. With that, we will conclude this session. Take care. Good night. Good night, everyone. Thank you.
Thank you.